Welcome YouTube fans of Wall Street Station. Welcome to a brand new series that's about to evolutionize and change drastically the way you think about the stock market and investing. So I'm thrilled to introduce you to Market Bullets, your go-to source for insightful and engaging content that covers a wide spectrum of topics from investing strategies to the broader economic landscape. So in Market Bullets, we are not just talking about stocks. We are diving deep into the intricate world of financial markets, focusing on macroeconomy and exploring investment opportunities, dissecting economic trends, offering expert insights that can empower you on your journey of financial success. So I'm very glad you decided to pop in, but let me know whether this type of a content is somewhat knowledgeable for you, somewhat useful. Do you find this series to be continued? So I'm very curious of what's your stance, and without any further ado, we are jumping to first element. So the market bullet for today is about the Charlie Munger. I wanted to pay tribute to that guy. This guy has had a great impact on markets, on investing overall, and that's the one that Mr. Buffett always credited to. Buffett credited Munger with pushing him beyond his early value investing strategies to buy great businesses at good prices, like, for instance, See's Candy, and he taught him a lot about valuing businesses, about human nature, and that everything added up to a success of Warren Buffett and Berkshire Hathaway upon a way. So that's the guy that will be remembered for long and will stay in our memory for the decades, centuries, or even millions to come. All right, so we are right now jumping to element of economy. First, let's head on to what's going on with United States. United States right here is going with the greatest GDP gauge since January, since it was in December, the higher one. So right now we are in this rising tendency, and what you can find right here is that this gross domestic product in the United States expanded 5.2% in the third quarter of 2023. So it means that right now the expectations may notch higher. However, this one for the next for December is expected to deliver a little bit lower gauge. So right now, overall, there is no darkening skies for the economy in this report. Anyway, growth is cooling, and what we can expect right there is probably the tension that will be somewhat meandering along this positive and neutral level. So we may go through some reverberations, but there shouldn't be many been done about hopes for better outcome being dashed in the first few quarters of next year. So right now we are getting to Euro area. As you do know, that are somewhat of a connected vessels right here. So when the inflation has risen in United States right after there was in Euro area, and in reverse, at least in the recent history. So right now we are getting through this world-shattering moments of this 10% inflation, 10% inflation. And right now it looks like we have gone through the worst already. Such elements as food, alcohol, and energy prices are tumbling, and along with this gauge exactly. So you have right here the previous tendency that is kinda overwhelming positively economies, and right now we have a chance to catch up with the target, inflation target for euro area around 2%. When it comes to US, also let's have a look at labor income and rent inflation. So that's something that caught my eye recently, and you can find right here that growth in gross labor income, the aggregate wages and salaries of all workers in the economy, continues to decline as the labor market slows toward normal pre-pandemic growth rates. So we can find this V-shaped type of trajectory showing that after the jolts, we are right now on a golden path to normalization of the elements. All right, so we are right here jumping to overall view on the market. So you have probably wondered what will happen to the market after the interest rate cut, but at first let's find out where in this breadth of the market environment we currently sitting at. So right now we are in an environment where those narrowing of the market is getting through a greater increase. You can find right here that Magnificent Seven are dominating the market, almost the same as it was back with Nifty 50, with a little bit lower scale, but also the one that is worth noting, and also with tech bubble back in 2000s. So everything should get fine, but the lesson from this is when leadership gets so lopsided, the tide can turn under any circumstances bullish or bearish. And if we get that long-awaited recession in 2024, it could happen in a broadening tape. Few investors will have that on their bingo card for 2024. So you have to be very kind of wary, as the recession doesn't really omit this large type stocks, but those are the ones that are falling the last. So that's the characteristics of bull markets. Right here you have market cycles and breadth. So the market recovery has been unusual with very narrow leadership, but it's not the first time. And right here you have also the comparison to tech bubble and Nifty 50 with this SPX price gauges at 32% lately. Previously that was 119, but still that's nowhere near from what we were going through during the tech bubble. However, we have jumped for a greater percentage amount than it was back in Nifty 50 times in 70s. So we are somewhere in the middle of those two bubbles. Right here you have the last tightening, and that's what exactly I will have pointed to. So after the last tightening, we can find that if the Fed has reached the end of its tightening cycle, we are normally going with a little bit like of a negative tendency. So the majority, or on average, we are tending to move lower, and that's what exactly is about to expect this time. So even though we are finding ourselves to supposedly have this great time ahead with this final rate cuts, it normally does coincide with also very difficult moments for the broad market. So typically an easing cycle starts relatively soon, although the Fed has from time to time stayed sideways for a while. So with this moment right now we are staying sideways, but there is very difficult moment ahead of Fed, because the Fed is waiting for something to crash, and if that may eventually crash, it may lower down the valuations even higher. So when it comes to another metrics, average 12-month return following last Fed hike, showing that money market after 12 months following the last Fed hike are getting a little bit more stabilized, but still after these first shocks, it's normally at first going through these difficult phases I have just pointed right there. So the market has been pushed at first on this rate hikes ending period, but right now with this normalization and then calming down the situation, we may have the valuations of the stocks eventually getting a little bit smashed. So right now we are jumping to another element, and that's let's maybe just get through the stock market. So anyway, even though the market is expecting the rate cuts to eventually get elevated, there is normally no really much of a premise to time the stock market. Normally, when you're starting to time the stock market, you have a kind of a many headwinds ahead of your thinking, many type of a mindful handicaps, and by assessing the trajectory of the market, you are more prone to a negative returns rather than positive. At least you have a particular very good premises to do so. Otherwise, I wouldn't make it. So average excess return is at minus 1.1% per year for those that are betting and timing the market. That's why if you adjust the beginning of the pre-advanced trader or investor, I wouldn't really time the market. So that's only for the professionals, and majority that are trying to do so are failing. So right here you have that kind of a distribution, this breakdown of annualized excess returns for 700 to 20 timing strategies, and that one is falling very heavily. In the meanwhile, that guys that were betting for Apple and trying to time the market by buying the Apple right before its new type of iPhone's presentations and debuts, could have instead bought the Monster beverage and done much better than the Apple shareholders. So even though the mainstream media is talking about just Apple that is crushing the scene and having the greatest momentum among all stocks, the other stocks that are not so favorable by mainstream media are gaining even bigger. So that's the proof, one of the proofs that you cannot really time the market by easy way, just listening to what the those so-called pundits on the media TV are telling you. Right here you have a current situation, and right here you can find that active clients getting long on JP Morgan's. So that's Treasury 10-year yield, and that means that this 60-40 portfolio is about to come back supposedly. So that's the positive for those that were just laid and the foundations of the portfolio on this type of a strategy. US bonds on pace for best month since 1980s, and you can find right here exactly that this strategy about to make profit this month and this month and supposedly next to come. Bill Ackman's this time, however, is making another bet, and they are betting for Federal Reserve to go to have to cut rates more quickly than people expect, and that was exactly why the market is betting for a bond. So that's all add up to this stance, and exactly what I wanted to point out is that the market is so cold right now. Bill Ackman's driven after a few type of a very good bets on the market. Market is listening to what he says, and it may eventually also come over with this FOMO and premature rate cuts somewhere around first and second quarter of the next year. In terms of Wall Street, Wall Street's crystal ball is pointing for mainly 5,000 points of Bank of America and Deutsche Bank, and out of the other American banks, we do assessing around 4,500 and 4,000. So let me know which of you of those gauges, of those objectives you are buying. All right, so we are right now getting to next element, and we haven't just gone through the this type of a dot-com bubble comparison. So right here you have a number of S&P 500 companies citing AI on earnings calls, and that's around 200 of them. So in comparison to what the past has brought, right now we are about to get AI bubble driven. Dot-com bubble has, however, been over 2 times bigger than the bubble that's right now, and that means that still, in comparison to what has been right then, we still have a room to grow. In terms of returns for combined ETF and mutual fund flows to equity funds, we can find that this one is at a negative level right here in comparison to dot-com bubble, where influx of money was really outstanding. Right now we are jumping to another section, so let me just go through the crypto. So crypto right now has making a outstanding gains. That's the one of the sector that is the hottest out of the all of around this year. And crypto, where its largest Bitcoin futures ETF breaks 2021 record highs for assets under management. So Proceed's BITO has 1.47 billion in holdings, and it's about to supposedly rise even further. Unlike some other Bitcoin futures ETFs, BITO closely tracks the asset spot prices, which has likely added to its allure among traders. And right now it's kind of a presage of what may come with supposedly coming ETFs, spot ETFs for Bitcoin. In terms of the other type of alternatives for crypto, for the whole most important names, what I mean by Bitcoin and Ethereum, we have also other names. So for instance, if you are betting for other type of cryptos, you have, for instance, some narratives revolving around L1s. That's many tokens that are performing in this branch. Also L2s that are about to scale the Ethereum procedures, and also around DeFi. There is much about DeFi that happens right now, and also other things as GameFi that I will just talk in a next episode a bit, as it's also gaining traction. So that's a window to seize the generational wealth opportunity, and that's a kind of a narratives that you may choose among this crypto world, and that are about to gain even more tractions when this bull cycle accelerate. So those are some of the phases that are getting more vocal with every month, with every another catalyst for Bitcoin's growth, and we'll tiptoeing around those elements in the future episodes. So if you're enjoying this one, just subscribe to the channel. Right here you have the one of the crypto narrative that may be dominant in the 2024, and those are LST, so liquid staking tokens that play essential role in the DeFi ecosystem, offering users a way to participate in cryptocurrency staking without the hassles of running validator nodes and managing hardware and software. So it's kind of a getting dividend out of your coin shares. So you have within this LST narrative the type of tokens that are within the rebase tokens. There are tokens that automatically adjust their balance in response to deposits and rewards, also rewards bearing tokens, and wrapped tokens that also are somewhat delayed in terms of rewards, but also giving an edge on the market. In terms of another element, I want to just point out the kind of influx, the very mysterious influx of Bitcoin that right now taking place. So Mr. Whale keeps up its daily buying streak, acquiring over 500 Bitcoins on Friday. There was following the accumulation of almost over 1,200 BTC. So we can find that more and more whales are flowing into the ecosystem, and that what may eventually take place with this acceleration of a bull market even stronger. So right here you can find, let me just right here you can find the whales that are just sitting on its backs, and right then we are going through miscellaneous type of topics. So American households are much better positioned financially, and that's kind of a surprising. So how is it possible that the consumer hasn't slowed down at all? And we can find that right now the simplest answer is consumers locked in debt at much lower rates, and higher rates didn't impact them nearly as much as many expected. Right now, as we have a chance to roll over the debt, why not to enjoy the party even longer? That's the graph that couldn't really load up, so I will just skip it. And that was about the amount of companies that are about to have their debts matured in 2030, but still there are a couple of years ahead of us before it eventually they get matured. So still we have this party getting longer for years to come. When it comes to robots, eventually we have our very important topic. So robots may in the future inside trade, and many companies are battling amongst themselves for AI talents, and there are some even threats to humans as traders or investors that those robots may have a greater knowledge than humans, and much more quickly will really process the type of information and really read this out more properly. So it may lead even to AI deception led by this type of robot models on a market. So it will be much more difficult to recognize the patterns such as head and shoulders or any type of other patterns. And even though there might be an ethical dilemma, we do know that the markets are about to get in profits, and those owners of those robots will be betting on those profits, even though this ethical dilemmas may persist. So what about the environment, the future, where the robots will be buying themselves yachts and other type of extreme type of luxury type of goods for the profits from the market? This will be kind of not easy to comprehend, but that may eventually come. Let me know in the comment section what you think about it. When it comes to another elements out of the miscellaneous type of a content, so right here you have CEO to worker pay gap source, and it's difficult to wrap our minds around what these numbers actually mean. Right here you can really visualize if an average family can afford a house and a car, a top 100 CEO can afford over 800 of them. Over 800 of them, and also 800 of homes with no much problem. But even though these discrepancies are much of a large problem, something that may be turmoil engulfing are those labor organizations that may provide a ray of hope in this growing darkness as they struggle against inequality. So have hopefully unions will intervene, and those things will eventually get better. When it comes to the wrapping up our transmission, you have right here the kind of a cheat sheet of mistakes new investors make and the ones that you need to avoid. Among them, there is following Kramer's advice. Obviously, that's the one you want to act against normally rather than listen to him. And another thing that is I would find it as highly risky is that YOLO bets, such as betting also and on what the YouTubers are buying. So whenever I'm just recommending or so-called recommending any type of bets, always do your own research afterwards. Do not trust blindly. Also, very risky is buying penny stocks. There is a large volatility and other things related to that. Also, there are some thinking dilemmas, such as any type of a cognitive biases, and not educating yourself is the one thing that also adding up to the great problem. Overall, that's it in today's episode. Thank you very much for watching, but let me know what you think about this type of a content. I'm very curious of it, and we'll get back to your thoughts in the time to come. This moment, that's everything. Thank you very much, and